Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500, and I quickly want to show you this chart here of the small trader put buying that's absolutely spiking over the past couple of weeks. The last time this happened was back here in the pandemic lows. When you see a lot of small traders buying puts, it means there's a lot of panic and a lot of concern amongst retail investors, and that's not necessarily concern that's justified. And what can often happen with these types of spikes is it marks significant buying opportunities in the stock market. I'm just quickly highlighting these big spikes corresponding to these big lows. So we're going to be talking about this extensively. We're going to be taking a look at many indicators of sentiment right now and analyze where the markets are heading next. A lot of people on the internet, whether that's on YouTube or on Twitter, are calling for this to be the beginning of a much larger move down on the stock market. You know, of course, we have high valuations. We've been rallying for quite some time. There's plenty of reason to be bearish on stocks, but we're here to give you a balanced approach to the market and not make you sell your stocks when this could perhaps prove to be one of the biggest buying opportunities of the year. If you're interested in following these crazy markets with us, make sure to click on that subscribe button. If you enjoyed this video, don't forget to smash the like button. It really does make all the research and all the effort that goes into making these videos worthwhile just for the couple of seconds it takes for you to hit that gray thumb. Now, without further ado, let's get right into it. So I believe it was this video that we posted a couple of weeks ago as the markets were absolutely tanking. We talked about this big breakdown that we had on the S&P 500 as the markets were really tanking down here, and we had a big panic move. We talked about the fear and greed model that was hovering in the extreme fear territory, and that often corresponds to buying opportunities. And we also talked about the market breadth. So this is the percentage of stocks above their 50-day moving average. We can put the S&P 500 on top of this chart, and you can see every time you see the breadth go into oversold territory, it tends to mark a big buying opportunity in the market. That's held up true for the past couple of years. If you've been following our channel, you'll know this is one of the indicators that we love to look at when we're still expecting higher highs on the stock market. So right now you can see we've had a relatively small bounce on the S&P 500. So far this has held up to be true, but you can see, I believe I talked about this in that video, you can often have types of double dips in the stock market breadth like we had back here in that Evergrande crisis. So perhaps a retest of the low is not out of the question, but in general here in this zone, the buying opportunity this represents is a lot bigger than the potential risk to the downside that we see in the short term. And that's where I want to show you another chart here of the put call ratio. Now, again, if you're a fan of our channel, you'll know that we love to use this indicator. You know, trading, the type of trading we do, swing trading over multiple weeks, is not rocket science. We look at the same data, the same stuff, and it's just all about being systematic and following simple rules. You want to be buying when there's a lot of panic in the market. So when you see the number of puts absolutely spiking relative to the number of calls in the market, it's telling you that there's a buying opportunity here, right? This is the COVID-19 crash where the put call ratio absolutely skyrocketed, and ever since then, you've had multiple buying opportunities when the put call ratio has spiked, right? This is the Evergrande where everyone was calling again for the beginning of a major meltdown in the stock market because China was going to pull down the rest of the stock market, was going to pull down the rest of the world with it. If you were here, if you were watching our videos, you'll know that we were buying the dip back here. And right now it doesn't look like this is any different. Now, this video is really about making a recap of all the big developments that have happened over the past few weeks, and that's why I have to look at the tech sector. This is the NASDAQ 100, and this is really what has pulled down the rest of the market. Ever since the all-time high on the NASDAQ, we've had an 18% drop from top to bottom. And so, of course, considering the tech sector makes up a significant part of the S&P 500, that's going to pull down the market. That's exactly what's been happening. In fact, if we take a look at one of our favorite charts, and that is the NASDAQ 100 divided by the S&P 500, you can see the underperformance we've had throughout the months of December and January, where really the technology sector has taken a massive beating. So what's next? It's one thing to analyze what has happened over the past couple of months, but can we really expect this to bounce? Can we really expect tech to recover from this? Or should we be cautious of a breakdown in the technology sector? Again, like many people are expecting this to be some massive topping pattern for tech to head much, much lower. And that's where I want to add the 10-year yield on this chart. This may all look very complicated, but it's really not. Technology is sensitive to yields. So this is the 10-year yield. And when you see it go up rapidly, for example, right here between January 2021 and March 2021, that tends to correspond to moments where technology is going down. And so the stock market is going down too. Or you can see every time you have rapidly rising yields, you have volatility on the tech sector. And that has held up true in this recent move. We've had rising yields and falling tech stocks. So if we can figure out where yields are going next, we can figure out where tech is going next. And if we know where tech is going next, we know where the stock market is going next. So you can see here, right here, for example, when yields are going down here, the tech sector recovers. So let me put up a more clear chart of the 10-year bond yield that really has made an aggressive move up. Even on Tuesday, we're seeing a 2.45% move up on yields. That's an aggressive move up higher, and we're getting closer and closer to our target zone of 2%. Now, why did I highlight this zone in green? Because there's a lot of resistance here. Look at this. At 2.02%, there's a big reaction here. Lots of reactions here, right here as well. So it's a big zone of resistance that we're currently entering. Now, whether we reverse straight away or we see a little bit more upside before we reverse, who knows? But if I add the RSI on this chart, you can see we're starting to see divergence between yields that are going higher and the RSI that's starting to make lower highs with momentum fading, telling you that this move here is perhaps slowly coming towards an end, similar to what we were seeing here with higher highs on yields and the RSI going down. Same thing here, rising yields, but RSI going down, telling you that we're about to see a little bit of a consolidation. So once that happens, once we see that cool down in yields, could we see maybe a correction, perhaps even back down to 1.6%, all the way down to this trendline support before we ultimately resume the move higher? That is very possible. In fact, I would favor that type of scenario. And that would mean that the tech sector that's currently at support here, at least the ratio between the NASDAQ 100 and the S&P 500 that's testing support, that would resume off that level and head on higher. Now, again, we could see a few more days of rising yield, so maybe we undercut it. There's still a little bit of support here on these reactions. Could we see one last move down on the tech sector before we resume higher? Absolutely. The point is that right here, as I speak in front of this chart, the risk reward is more favorable to the upside than to the downside. I don't see yields going on a parabolic move just yet. I think there's a lot more chance that we see them cool down a little bit. And by the way, the same logic applies to the ARK Innovation ETF. These are stocks, these emerging technology stocks have taken a 60% hit throughout 2021 and 2022. Could we see a big recovery on these stocks Absolutely. In fact, both of these trades, the NASDAQ 100 and the ARK ETF, are going to be added to our trading watch list. So that means that we're going to be making more regular updates on these, following them every step of the way, whether or not they're still favorable trades, and when we should be looking to rotate out of these trades. If you're a trader, whether that's beginner or expert, and you're looking for consistent information, consistent data that's going to give you an edge over other traders, make sure to check out our website at gameoftrades.net. We make these very dense updates on the market, covering everything from the sentiment to the technicals, different assets and their impact on the market. And of course, we have a summary if you don't have time to read the entire article. Our goal is really to build the best research service for trading and investing. So make sure to get yourself a membership. Join our community of traders. We're really trying to push this out as cheaply as possible to as many people as possible, because as we expand the service and add new features, we will be increasing the price. Now that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to click on that like button and subscribe if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.